Hello and welcome back to the Volunteer Income Tax Training Series. My name is Chris Moon. I am an Associate Teaching Professor at Iowa State University in the Ivy College of Business. In this training video, we are going to focus on retirement income. And the very first screen you see here is the intake form again. The intake form is commonly something that we're talking about, and it is really important to note for retirement income that we have the taxpayer's date of birth and we know that they are receiving retirement income and that they have copies of their 1099-Rs. All right, so one thing that I haven't really mentioned and that does apply here with the retirement income section is when you're looking at this intake form, next to the checkbox, you're going to see either a B or an A. That stands for basic or advanced certification. So if you if you're certified at the advanced level, you really don't need to be concerned much about it because you're going to be certified to do either one of them. But if you are a preparer that is only certified at the basic level and you get an intake form that has items marked that have an A next to it, you need to know that you are not eligible to do that tax return. You'll need to get it to someone who has the advanced level. So we will go through and talk about retirement income here. I think there's going to be someone doing a separate video on the Iowa return, but I will just let you know or remind you, for those of you that already know, that your retirement income is generally not taxed in the state of Iowa now. So just making sure as you transfer from the federal to the state return that you mark that if the taxpayer qualifies to have the retirement income not be taxed in the state of Iowa, that you make sure you mark that on the appropriate section on the state of Iowa return. So we are going to, in this lesson, determine how retirement income is reported. Some of the retirement income that taxpayers receive is taxable and some of it is not, so we'll determine how to calculate that and how to report it on the return and determine if the taxpayer needs to make an adjustment to their withholding on taxes. All right. If a taxpayer receives retirement income, they will generally come in with a 1099-R. And there are several different 1099-R forms, and sometimes they look a little different. But this example is a basic 1099-R. It shows in box 1 the gross distribution, and in box 2A the taxable amount. You will have situations where the taxable amount is not included on the 1099-R. Generally, the gross distribution is all taxable, but that's not always true. So it's important to go through, figure out what type of distribution this was, and whether it was, whether the taxpayer paid in with pre or post tax dollars, and who contributed to the fund, whether it was the taxpayer or the employer or both. All right, so important to be able to know to ask those questions if the taxpayer has retirement. So retirement plans are either funded by before tax or after tax contributions, and whether or not the distribution of the retirement is taxable depends on who contributed and with what kind of dollars. So if the employee didn't contribute anything, if only the employer contributed, the distribution is fully taxable. If the employee contributed with before tax dollars, the distribution is again fully taxable. If the employee contributed with after tax contributions, then it's partially taxable. So it's dependent on a certain portion of that is going to be taxable and a certain portion of that is tax-free. All right, there are two different types of IRA distributions that you might see. We're also going to cover this again when we talk about contributions to an IRA. There are Roth IRA distributions and traditional IRA distributions. Roth IRA distributions, as a general rule, are tax-free because those contributions are made with after-tax dollars. And so you're not going to get taxed on it again when you get the distribution. Traditional IRA distributions may be fully or partially taxable because the contributions that you made, but when you made the contribution, you may have been able to deduct that from your taxable income or not. So it really depends on when you made the contribution, whether that contribution itself was deductible from your taxable income or not. There may be some additional taxes. Generally, we call this a penalty if you have non-qualified distributions from a Roth IRA. So if you have someone who made non-qualified Roth IRA distributions, we generally recommend that we just refer that to a professional tax preparer. Okay, so that issue is not necessarily out of scope, but we do want to refer that out. So distributions from simpler SEP IRAs are in scope for VITA because they're taxable and reported on the return just like a traditional IRA. I will tell you, again, it's so important that we look at the scope document. We're always taking a look at the scope document to see whether or not we should be doing this return. And as I'm looking at the 1099-R, it's in scope, so we can handle this for distributions from pensions, annuities, retirement or profit-sharing plans, IRAs, insurance contracts, etc. But it is not in scope for IRA rollovers that do not meet the tax-free requirement, taxpayers who need the general rule to figure out the taxable portion. We'll talk about that in a moment. And there are, in box 7 of the 1099-R, if there are specific codes in there, then it is out of scope. So make sure you're looking at, number one, it's really important to make sure you get the right code entered from the 1099-R into TaxSlayer. But if any one of these codes that are listed in the out of scope document are on that 1099-R, we need to just send them away. So before you even start the return, look at the codes in box 7 on the 1099-R. Make sure that the return is going to be in scope before you even get started. Okay, so pensions and annuities. When are they fully taxable? If the taxpayer did not pay any part of the cost of their employee pensions or annuities, so the employer paid the entire thing. If the employer did not withhold part of the cost from the taxpayer's pay while they worked, employers withheld part of the cost from taxpayers before tax pay while they work. So under those circumstances, pensions and annuities are going to be fully taxable. If you're looking in box, 2A, and it doesn't tell you, or box 2B, I'm sorry, doesn't tell you what portion is taxable. We can use the simplified method to determine the taxable portion of a pension or annuity. If you need to use the general rule, then you've got it, it's out of scope and you've got to send them to someone else, a paid preparer, to do the return. All right, so make sure if that taxable portion is not filled out, you can use the simplified method. You can actually just click a button in TaxSlayer and it takes you through a Q&A so that you can figure out the taxable portion, but do not do the general rule. That's out of scope. If a taxpayer is getting disability from a retirement plan, that is taxed differently depending on the age of the taxpayer. So if they're before minimum retirement age, it's wages. If they are after retirement age, it is taxed as a pension. There may be some additional taxes on qualified plans. Form 5329 is what is going to be produced if this happens. Sometimes there will be distributions that are made too early. So there is an additional tax on early distributions. It's a 10% penalty, I call it, but it's an additional tax. And just note that if you take out an IRA early and you have this Form 5329 that is produced, there are certain exceptions to this additional tax, and there is a link that you can use on TaxSlayer to kind of go through and do a Q&A to see if the taxpayer qualifies for any of those exceptions to the 10% penalty. One of them is for educational purposes. I don't have all of them memorized, but I do know there's a specific or has been in the past a specific exception for a victim of domestic violence, and if they needed to take money out for living expenses. So, I mean, there's just a number of them. So make sure if the client is being charged this additional 10% tax or penalty that we just go through those exceptions really quick to make sure none of them apply to the client. Okay, there are times when we may want to suggest that a client adjust their withholding. If they owe more than $1,000 on their tax return, I always suggest that they amend their withholding, and they can do that with their retirements through their either through voluntary withholding or the form that's been provided by their former employer or retirement company. All right, so if they owe more than $1,000, they're going to start getting penalties, so we need to advise them to amend their withholding, increase it, so that they're not going to be subject to penalties for not withholding enough. All right, so in this lesson we talked about the 1099-R, and if the taxable portion of that retirement income is not listed on the 1099-R, we're going to use the simplified method only to calculate that. The types of retirement income and the forms that are used to report it. The minimum distributions, we didn't actually talk about the requirements for that, but generally the retirement company is automatically going to send you any required minimum distributions, and if they owe more than $1,000 on taxes, make sure that you advise them to adjust their withholding. So this form talks about what is out of scope for this lesson, and just make sure you take a look at this. Here are all the codes that I talked about that will show up on the 1099-R that are out of scope, and taking a look at the scope document and also this sheet here to see if anything is out of scope and we're not allowed to do it. All right, that concludes the lesson on retirement. Thank you.